Dennis, hi. How's it going?
Doing well. How are you?
Yeah, not bad. Fresh out of our crypto brunch this morning, last one of the year here in London, which you were on the panel of. Thank you very much for contribution this morning. It was a good conversation, wasn't it?
Yes, it was a great panel. We had quite a good discussion talking about more of the infrastructure topic. But thank you for hosting. It's definitely a good time an exciting time in the industry.
Yeah, there was an analogy that Patrick Martin said on the panel about the sun coming up and even if you're not holding anything, which is bouncing, it making everyone feel a bit warmer and brighter. Basically, it's a nice place to be.
Exactly. There's quite exciting things happening in the regulatory environment, especially in the U.S. With this new ETF approval that's imminent, but also similarly exciting things on the trading infrastructure side from clients and the demands that they've been having.
We were talking about the cooperation side of things between the various entities, service providers, infrastructure, people in the space, and that feels like it's getting to be more collaborative, and those lines of communication are a bit more open. Is that fair?
Yeah, that's definitely fair to say. So from our point of view as a liquidity aggregator of sorts, we have to have really strong partnerships with both trading venues and with clients who provide that volume. So facilitating that relationship through our technology does take a lot of work and partnership and collaboration, but it's all really in an effort for the maturity of the greater industry. So really what we facilitate is just direct market access for clients to obtain low latency connectivity to exchanges and obtain the lowest slippage and best price execution possible. So through that, the clients are happy because they're trading at the best price that they would like to, and the trading venues are happy because they're getting the volume and the liquidity that they need on their platform. So from our point of view in making that connection, that continuous connection, because we're growing that volume for the platforms, it's really a win-win for everybody. So it's a nice position to be in.
Fantastic. Just kind of zooming out a little bit, we've known you guys for probably 3 or 4 years now, in Miami and New York and in London, and you've been a long-time partner of ours, which is great. We love working with you guys. But in that time, there's been quite a significant evolution from the original data offering to this execution. Can you talk a bit about that and like the origins and why the evolution?
Yeah, of course. So we initially started as a low latency live market data provider. And that, as we proceeded with that vision, the clients that we were dealing with were all telling us as their feedback that because the data was so high frequency and low latency focused, they weren't able to take full benefit and advantage of that data because their execution speeds were always slower. So the input was way faster than the output, essentially. Mm-hmm. And that created a big problem for them, but also for us because our business was entirely focused on the speed. So then we took the natural path to go ahead and build an order execution system, which those clients have been using along with that low latency data to take full benefit. So now they're basically using us for both that input and that output. So they're getting the connectivity they need to on the exchanges for the direct market access. And then they also get the execution that they need. So right now it's direct market access, but in the next year or so for what's ahead, we'll really start to look into some optimal execution algos and connecting with different venues. So right now we're focused on centralized venues, centralized exchanges, but really the market broadens up to centralized exchanges, decentralized exchanges, market makers, OTC desks, prime brokers. So connecting those trading venues and facilitating direct market access to those clients. So that could be crypto native funds, traditional hedge funds, private equity firms, VC firms, really any trading partner that needs direct market access. So we're facilitating that connection, and it's been, on the business side, a really smart decision and evolution, natural evolution of a product. And the clients are definitely happy because they're able to get full benefit out of that latency advantage.
So you've been designing that specifically with live clients and getting feedback as you're building it?
Yeah, so that's entirely based on the live feedback that we've been able to source.
Moving in real time. That's a good place to be, especially if you've got existing base and then pushing out into the execution.
Yeah, it's like building an airplane as it's taking off. Really,
very familiar with that process.
Startup analogy.
Jump off a cliff and build the plane before you hit the ground. Done that a few times. How does that, moving in or expanding the offering? How are you finding that within the wider infrastructure and how the general infrastructure is developing, especially obviously since, I have to bring it up, but post FTX and Binance more recently. What's your take on the infrastructure in general at the moment?
Right. So I think the wider digital asset industry, especially as it applies to trading infrastructure, is built on the hopes of a very advanced technological platform, but the reality is it's quite clunky still. Better than traditional markets, but it's still not institutional grade, as everyone likes to call themselves. So what are the problems? These systems are very slow, so they take in the hundreds of milliseconds to place trades, which introduces a significant amount of slippage on prices. So if a client wants to execute at a certain price, they're getting filled at certain basis points higher that does not give them any advantage in the markets. In fact, it disadvantages them. So there's the execution, which is a big issue on the speed. And that applies to not just high-frequency traders, but also any type of trader, really, even long-only traders, because any price they need, they won't get the best of. So there's the latency issue, then there's a privacy component. So a lot of the infrastructure that's currently built routes through the servers of those service providers who are facilitating that service. So many current execution providers will have trades going through their servers, which they're able to see the full data and IP behind the trades that are being done, and that introduces significant front-running risk. So if you're a competitor execution provider and you see this flow coming through, you can easily delay the trade and place trades ahead of them in order to get advantageous placement. So that is a big risk that a lot of funds are not totally comfortable with, but they don't really have an option right now unless they go and build it in-house. So we've seen the rise in popularity of the decision for many high-quality institutions in the digital asset space build in-house. And that comes at a large cost because it's expensive, it takes a lot of time, and you don't have a service provider agreement being there to support you. That's why in traditional markets you have all these funds outsourcing their tech to different components. So you have the execution being one provider, you have the risk management being done by another provider, you have the portfolio management, the data, all these different components that are segregated, as it should be, because it's really hard to build a good platform all by yourself. So the privacy element is a really big comfortability factor, which we've been able to provide. So clients, their entire application is on their own servers, and we just provide that infrastructure and connectivity so they can get best execution and direct market access quickly. Now, the third component, other than the execution and the privacy, is on the pricing side. So with current execution providers, and even when you factor in custody and exchange fees and prime fees, it's hard to generate any sort of alpha when those clients are paying between 1 and 5 basis points probably per trade before they even make the trade. And that's quite costly, especially when you're trading intraday, but even when you're trading tens of millions of dollars or even in the billions, it's a really big hit to that trading strategy that's aiming to trade. So on the execution side, we don't really believe in charging based on volume. Instead, it's all fixed as it should be, which allows the client to focus on their trading and not focus on trying to avoid fees or making a minimum amount of alpha just to break even. Because technically they're in the hole before they even start the trade, which is not conducive to any type of trading strategy. I mean, you've probably seen this from clients on like the cap intro side. Like they display a bunch of these strategies that are back tested, but the strategies that are being back tested aren't taking real live fees in consideration. And there's also market impact, which is a huge component. So we're aiming to eliminate that burden on clients so they have the best execution, they have the privacy, and they have the favorable fee structure to facilitate all of this.
Well, okay. There's some serious thoughts going into this. There's never a bad back test, right? Yeah, you don't take into account enough. It's always a lovely straight line and perfect performance. Coming from the CTO world, I know that one quite well. Talking a bit about the clients and people who are originally buying the data and are now looking at that execution play. Do you have a typical avatar of your current clients? Is there a spectrum? Who's buying the product is what I'm asking.
So right now it's largely targeted towards quant and systematic mid to high frequency hedge funds that are typically crypto native. So they have a lot of experience in this space. They've been trading for quite a while, typically like maybe 3 to 5 years in the space. And they've been able to weather numerous events in the space, including the FTX collapse, and dealt with various forms and pieces of trading infrastructure and service providers. So what we've seen in the space is, and especially the evolution of interests on the trading infrastructure side, is there's been an increasing demand towards demanding that institutional grade service that they haven't been able to receive. And a lot of them, as I said earlier, have had to build in-house. So there's that growing frustration that exists because they can't capitalize on the opportunities in front of them due to the high barrier to generate alpha on the fee side, the privacy components, which their own LPs and investors are not comfortable with. And then on the execution side, they're pressured to take average execution, which is not of the service that they demand, really. Mm-hmm. So as big players start to come into the space, a lot of these smaller crypto native funds with 10 to 50 million in AUM, but they do like 1 to 5 billion in monthly turnover, they're getting slowly cornered out and squeezed out of the market. And that'll gradually occur. And for any market, we'd like to see the most amount of participants as possible. And seeing the big players come in while the smaller players getting cornered out isn't totally favorable. But we can have both at the same time. It just takes the proper infrastructure to do it. Mm-hmm. So that's what we aim to facilitate. And we're also able to facilitate that for those big institutional players. Mm-hmm. So it's really like evening the playing field. So we're providing small and big clients with that execution quality that they need. And then we're also providing those centralized venues and other trading venues with the volumes that they need to grow as well. So it's really creating a win-win and collaborative environment mm-hmm. for everyone.
Are you, having conversations with the big institutional players, the incumbent multi-billion-dollar funds who might be on and are adding crypto strategies? That must be quite a long RFP process with them and going. They must be really looking under the hood, but taking a lot of time. That's in play.
Yes. So the sales cycle, especially with the larger players could be like 6 months to even a year. So a lot of due diligence that goes behind that, even as a service provider, a lot of due diligence, a lot of testing behind the quality of the execution. But the good thing about our offering is it's essentially it's more raw in nature. So customers have the flexibility to, because it's self-hosted, they have the flexibility to build their strategy around it. They have the flexibility to build their own optimal execution algos around our offering. So we're just providing the infrastructure, so to speak, and like the plumbing that they need to connect to these trading venues and the speed to do it. But any alpha generation strategies, any other complex algorithms that they want to input into these algos, they're able to do through our system. So it's been good positioning. Everything takes time, but it's all for good.
Do you think there's been lots of talk this year about the rise and the prevalence of multi-strat funds across hedge fund world in general? I'm not talking specifically about crypto. Do you see that coming into this crypto space as well? Because if there's a bunch of shops with 10, 50 million and an incumbent's coming in with a multi-strategy offering that they can actually give some pretty grown-up infrastructure, surely that could be a potential move, because you can only survive so long as one of those small guys getting cornered out.
Yeah, so what I've seen have been multi-strat funds who are dealing in other asset classes. So like a balance of 80% equities and 20% crypto. A lot of funds are starting to introduce crypto strategies as a smaller percentage of their total trading to diversify their exposure, but also diversify their risk. So that this approach of exploring crypto trading strategies is a way to help them diversify their entire portfolio. But there has been a bit of a change in terms of the type of funds who've been active in the space. So, I mean, long-only funds, of course, are popular when the market is going up, and not so popular when it's turbulent at times. And for market-neutral funds, I mean, when the markets are volatile, it works out for them. And I mean, the allocators are always swimming, not always allocating, especially with this regulatory environment. So it's really up to the funds to adapt their own trading strategies and meet the infrastructure requirements to do so.
I wanted to ask about where you guys feel it is best in the world right now for this burgeoning industry, because obviously the US has been a little bit beaten up this year in terms of what's permitted or what's perceived, and the UK and Europe and Switzerland and also the Middle East obviously coming to the fore, as well as Asia, Singapore, Hong Kong, Tokyo. We've been talking about Australia this morning as well. Where are you looking to primarily for 24 and beyond?
So as for our clients, because we've seen quite a bit of clients move their registrations and even where they operate, some of them have been away from the US and towards a more global presence. So there's been a rise in popularity towards the Middle East and even the UK. So attending these AYU events, I can clearly tell that there's a growing interest here and in other parts of the world as well. And every country is coming out with their own favorable crypto laws, or at least progress towards that. The US has been much slower to accommodate to that, but the biggest factor here is that, or the biggest question is that, once there is US regulatory clarity, will all those institutions who moved away move back? And I think it wouldn't be unreasonable to say yes to that, because that's where all the capital is. And even if like Botswana comes out with favorable crypto regulation, like
not stacked with institutional investors.
exactly. So that's a bit of an extreme example, but you can get the idea. That's where all the capital is. It's where most of the talent is, and that's it'll probably remain that way for quite some time. And there are areas of like UK or the Middle East that will retain that talent and those clients who come in, and they're making an effort to do that to support them. So especially in the Middle East, like sovereign wealth funds and local investors there have made quite an effort to attract large funds and even service providers on the crypto side to relocate there. So that will probably work out for them long term, but the capital is largely concentrated in the US, so that's most likely where everyone will be headed back once there is some regulatory clarity.
Do you have an opinion, if not insight, on that clarity and when it might happen?
Well, I think the first baby step is with the Bitcoin ETF that's expected to either be approved or not be approved. But there's been a lot of big institutional players who have come into the space who have filed for these ETF applications. And I think the likelihood of them declining it is fairly low. But I also think that the digital asset community as a whole has been quite over-optimistic regarding the effects of this ETF approval, as if it's a holy grail towards institutional adoption. I think it's a great first step, but there's a lot of components with regards to the service providers involved, the actual trading infrastructure, the custody on or off exchanges. So there's a lot of components that need to be resolved before there's mass institutional adoption. And there's also, on the client side, there's a lot of funds with a large ego, so to speak, who claim that once there's an ETF application that goes through, the allocators will wake up and start pouring money into smaller funds. I think that isn't necessarily the case. For high-performing funds, it may be. And for funds who have demonstrated a decent track record and maturity over these events, that might be the case. But overall, I think it's a great first step if it does get approved.
So with that in mind and the kind of the longer term, I agree with the longer term positivity there. We just don't know, when and if that's going to happen. But I'm certainly positive. But if you were starting a crypto fund today, without any restrictions for where you personally could or would be in the world, where would you choose? Where would you choose to live and work and base the team?
Well, if it's a shorter term goal, like within the next 2 years, let's say, honestly, it would probably be somewhere in the Middle East for immediate regulatory purposes and relocation. It does take quite some time to get licenses and approvals, especially as an investment firm there, but they are quite accommodating towards new funds locating there. But that being said, there still is a requirement of capital. So there are many variables in place to even question starting a crypto fund anywhere that need to fall in line. But I think immediately that would probably be top choice as a personal opinion.
Interesting. Well, we're going to be in both Dubai and Abu Dhabi next year, hopefully with you guys as well, and arrange different partners to start leaning into that one too. We're quite excited about that, so lots to do.
That'd be great. And what types of traction are you seeing in the Middle East from AYU members?
There's certainly noises there. It's more of a push than a pull, because they're obviously trying to attract hedge funds and investors over there. So we are being pulled along with everyone else into that. It's less so people who are already there requesting to join. So it's a fresh market, and I think probably, as a community, and not just an AU community, but as a community in general for all service providers and funds and allocators, it's really interesting because it's a brand new thing.
Yep.
It's not like being pulled over to Chicago or LA or Miami or New York because people want us to host events there, which is historically how we've done things basically. And we'll be in New York and Miami specifically a lot next year. So yeah, brand new market, really fascinating, and then hopefully we can push out further to the Far East as well. But one step at a time. But we have some stuff coming with you in New York and Miami next year. I think on a monthly basis, we're returning with tennis and pickleball, which is a shared passion of both GoQuant and AU. That's going to be fun, isn't it?
That will be. I think it's a great partnership that we've had over the past year and more years to come. Definitely, members are exciting. There's new faces every time at any event we attend. So we'll be excited to start to host and sponsor and attend.
Yeah, Kian's going to be hosting some of his happy hours and looking after some AU members, and it's exciting to be going back to Miami for Hedge Fund Week in January as well, which is now home for you, right?
Yep. So we relocated there last year in September 2022, and they've been quite accommodating to us. It's been a great local tech ecosystem and crypto ecosystem there, crypto hub of the US really. Uh-huh. And it's just growing overall. We're growing our team and gradually expanding our presence there.
Fantastic. Well, we will have to get our tennis tournament back for Miami Hedge Fund Week, and the AU Yachts returning as well. So I'm sure we'll see you there next to Battlefin and all those guys as well.
We'll make sure to be ready for tennis. I might have to school you.
You do tennis, I'll do pickleball. So it's a lot easier.
Okay.
And then the other thing I wanted to talk about was skiing. We're going back to Verbier next year, and I think we're dragging you guys as well for our 4th year in Verbier, I think.
I hope so. So there's Verbier. Are you considering any other resorts?
It's definitely Verbier this year. Doesn't have to be for every year, but it has become a fan favourite, and the mountain dining with the flaming torches is now firmly in the calendar. So we have to go back for that. Obviously, we can do that elsewhere, but Chez Danny is one of the favourites.
Yeah. Verbier, I've been there before. Very nice resort.
We'll pull it over to the US at some point as well, or maybe up into Canada too, because that's also an area that you know pretty well.
Yes. Yeah, we could do a Jackson Hole trip.
Oh God, yes, very, very happily, very happily. I'm going to wrap up by asking if you could just give a couple of high-level predictions for next year, whether that's price action, blow-ups, any more FTXs hiding under the carpet, and just general opinion on what you think 24 is going to look like.
I think 2024 will be a year of maturity for the industry. So you'll see continued consolidation across smaller and bad actors in the space. A lot of people like to talk about the bad actors like FTX and other players, but a lot of people forget about the smaller actors that are disappearing. So that introduces new opportunity for partnerships and products that can come available. So the more smaller exchanges with less liquidity that die off is probably best for the industry, because you're having large amounts of liquidity consolidated near the top 10 or 20 venues. Same applies for tokens. With tokens, there's opportunity that lies underneath all of them, but you also have these smaller coins that have like $1 a day in volume. So you'll continue to see those start to die off. And I think along with this maturity comes this regulatory buzz. So hopefully, we all hope, and fingers crossed, that it continues to evolve, and especially that the US continues their push. So it's looking like it's headed in that direction, and I think we're all hoping that these ETFs get approved.
Here's hoping. I think it's certainly nice to have the sun somewhat shining on the industry again, and there's definitely a warmth there. So yeah, let's hope that 24 is what we want it to be.
I'm hearing it's crypto spring, so hopefully.
Fingers crossed.
Yeah.
Well, thank you, sir.
Thanks
you
for
coming,
guys.
and we'll see you in Miami in January.
Great. Thank you very much.